What the Fed said was unthinkable a month ago, what would have been impossible to consider 5 years ago, the Fed just did. I'll explain their big announcement, what it means for you, that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The Fed has lost all credibility and all control, guys. They never had control to begin with, but they certainly made it sound like it. They've lost all credibility. And I'm just going to, before I even show any headlines, I'm just going to tell you, okay, once again, in the fall of 2020, the Fed said, we don't think we can even create inflation. We want inflation to be higher. We don't even think we can create it. Of course, then they did, and they denied it, they denied it, they denied it until finally, so they said there is no inflation, inflation's transitory, blah, blah, blah. And then October of 2021, they finally said, okay, yeah, inflation's not transitory. It's a problem. Stock market didn't like it. And we've just been wrestling every single month with this issue. Fed has lost all credibility, okay? Take a look at this headline from just a month ago. A 75 basis point increase in the Fed funds rate is off the table. It's off the table. This week, the Federal Reserve announced that they are increasing the Fed funds rate by 75 basis points. That's right, 0.75%, moving their target rate for the overnight lending, the Fed funds rate, from 0.75, which it was at zero just at the beginning of the year, moved it from 0.75 up to a range of 1.5 to 1.75. They basically leaked this, and guys, I haven't done all the research. I just heard a little bit of rumors, but this was leaked. Of course, they always do this. They leak it to start getting the market used to it, so the market can correct and then cheer on the news. So this is what folks were expecting up to this week, right? But again, it was unthinkable. It was not even on the table to consider a month ago, and that's what we've seen. And the Fed is targeted that the Fed funds rate will be nearly or approximately 3.4% around there by the end of the year. That would be another 1.75% increase from where we are right now. We've got 4 Federal Reserve meetings left, and so you do the math there. We're talking, 0.5% to 0.75% increase, a couple of those in order to get from where we are right now to where we need to be. Now, interesting fact, as the Fed is making this announcement, they also lowered, what was also lowered was GDP forecast for this year. If you go to the Atlanta Fed GDP Now report, they're now estimating, they've moved it down again. They're expecting GDP for the second quarter of 2022 after the first quarter was revised to negative. They're now expecting it to be zero. Guys, we might already be in recession if that ticks to a negative number. We might already be there. I think there is growing consensus that that is the case. So the Fed has increased interest rates 75 basis points on the same day. GDP is lowered, and the Fed also, their future projection on that the unemployment rate will be higher a year and change from now. This is very interesting. We've never seen a interest rate hike like this in a bear market. Number one, that's never happened. When there's been a drop of 20% or more, the Fed has never been raising interest rates at this level. They haven't raised interest rates this much at one time since 1994. All sorts of record or just very unique circumstances with this. So the big question is why and what this means for you. Now, to start peeling back layers of that onion, at a 8.6% inflation level, a 1.5% Fed funds rate, guys, I don't want to scare you because obviously the market has done that already, but this is still easy money. This is still, if you look at what the Fed can either have a loose monetary policy or a tight monetary policy, depending on what they're trying to accomplish in the economy, based on their 2 mandates, which is stable prices, okay, throw that one out the window, and stable employment or maximum employment. Guys, an 8.6% inflation rate and a 1.5% Fed funds rate is still easy. Gosh, fathom that. Guys, this is just not nearly enough. But all of this is in response to every single month for the past several, the inflation data that comes out is worse than expected. It's worse than expected. When you take a look at the components of inflation, this is how it breaks down, the 8.6% reading for that came out in June for May. And take a look also at shelter. They're still wildly underestimating, underreporting the magnitude of shelter, the magnitude of rent prices, housing prices on inflation. Property taxes alone, right? This is just unbelievable. But the actual inflation numbers, which aren't even the real, like the numbers that you and I feel, are coming in higher each month. Let's hope that starts to, I mean, the big surprise and disappointment this time is it came in higher when everyone had been calling peak inflation. Did a couple videos even that experts were calling peak inflation. I hope this is now it. We will see, but this is in response. The Federal Reserve has to raise rates aggressively because inflation continues to be stubbornly staying at a high level. The stock market cheered the news. This is sort of a rally on this news because I think in a way the market is looking and saying, wait a second, the Fed has lost all credibility. They finally, though, came out with an aggressive rate hike to hopefully start dealing with and addressing the biggest problem in the economy, and that's inflation. And so the market cheered it, okay? The market was already in the green anticipating this sort of news. As the news came out, the market, when it's so sensitive, of course, it's going to react quickly. And after dropping down to breaking even, it then surged in the final hour and a half or so on Wednesday. We'll see if that continues. Ultimately, the reality is that's starting to be priced into the market is that that inflation is an issue that's going to erode and challenge profits, which companies are starting to reduce and change their forecast on. And the Fed is going to have to tighten the economy, tighten their monetary policy in order to deal with inflation. And so we've got a significant economic storm. When you add on the likelihood of a slowdown in the economy, a recession, a contraction in the economy, all of this, now, the market's already down in bear market territory, so how much further will it go? It just really depends on how stubborn inflation is, how quickly the Fed reacts, and how challenging the economic slowdown is, whether we actually see a recession. So then finally, taking this headline, what's it mean to you guys? The first thing it means is the Fed controls the Fed funds rate. That's the overnight lending rate, essentially, okay? The rest of the market, the rest of the free market, if the Fed keeps it free and doesn't manipulate it as it's done in the past, that moves based on based on traders. Okay, so stocks have, the open market has already adjusted interest rates significantly. We've got we've got the yield curve basically flat again, just about to invert. We saw mortgage rates move from 5.5% up to 6.6% for 30-year. We saw that happen in the past week. So what's this mean to you? Mortgage rates or loan rates, borrowing rates have already skyrocketed, and it looks like they may continue to do so. The day this news came out, the 10-year was down, which is great news, but it's still well above 3%. It is astounding what's happened to these interest rates even just year to date. So borrowing costs are going to continue to go up. They've increased significantly right up to this news. I would also tell you savings account interest rates, your high yield savings account, those sorts of things, those have been going up. I've told you those will respond slower than borrowing costs, but we're starting to see those increase. I think by next week or the following, we'll probably see some of these high yield interest rates being 1%, maybe even above 1%, which would be welcome news to you savers. Now, again, when you're trying to compete with 8.7% or realistically 10% inflation, earning 1% in the bank account is doing nothing for you. However, you've got those dollars there to keep you from going poor, not to make you rich. And if they can earn a little bit more interest than it was earning, that's fantastic. And then lastly, more headwinds and more volatility in the market. That's exactly what this means for you. And so meeting with an individual recently in his early 60s, hoping to retire or planning to retire by 70, he's on track for that. And I told him this might be your last great buying opportunity. It might last for another 12 months. It might be over right now. We don't know. But for you, this could be a great buying opportunity for you. Make sure you're taking the right level of risk in your overall portfolio, that you're not taking too much risk, but at the same time, new dollars being added in, depending on your time horizon, your risk tolerance. This might be a great opportunity to invest. It might even get greater. It might, stocks likely, if history, it plays out and we do see a recession and all of that, stocks might continue to get even cheaper, creating an even better buying opportunity. So work with your CFP on all of that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.